And we're kicking off with the liability-driven investment problem is bigger than it looks, which sort of says what it's going to do on the can. Right, just a quick plug for UK shareholders. We create public awareness of how the savings industry operates. We try and generate political force for change by basically lobbying the powers that be. And we are wholly, and this is important, we're wholly independent of the industry. Our policy team and our directors comprise mostly retired, in fact, wholly retired industry professionals with skills in business, accounting, law, financial economics, and regulation. Funded by members. If anyone feels like making a donation, if you go to the website, there's a big button saying donate. So that's enough of that. I'm going to start with just a little overview. So how did LDI come across to the average person, including at first me? We had the Kwarteng budget, Trussonomics. Then we had this massive market disruption with gilt prices, long gilt prices going all over the place. People were saying it's to do with pensions. Then we got the death spiral. Then the Bank of England intervened to buy gilt to drive the rate down. And that was that. That was the end of Trussonomics. And now we have a new PM. So that's a sort of parody of how we saw it. But as you're probably expecting, there's a story behind this, and there's a root cause of this, as I shall argue. Let's go back 20 or more years. You can treat a pension obligation. This may be controversial, and I don't want to go too deeply into this, but let's just assume that a pension obligation can be modeled as a massive great bond. If that is so, you can only hedge that bond obligation by going long a similar bond. So cash flow matches cash flow, and you are completely hedged. And that, I think, is up to the 90s how a lot of pension schemes did this. The problem was that bonds got expensive over 1990 to 2021, I think that should be. So interest rates go down, which they did. Price of bonds goes up. There's a little graph to show that. So the blue line is the long rate. Actually, the 19-year gilt rate. The reason it's the 19-year gilt rate is because that's the only continuous series of records I could find for the Bank of England. Anything beyond there, and it has sort of gaps in it. And I modeled the price of a 30-year bond for the same period. And yes, you can see as the interest rates go down, bond price goes up, which I'm sure everyone here knows. But I got tired of reading in the media commentary. There'd always be a sort of sentence saying, as interest rates go down, bond prices go up. And as a result, bonds became really expensive. You can see that from the red line. Schemes could not afford to hedge new pension obligations with bonds. So they didn't hedge. They invested in other sort of more volatile assets. And the fact that they couldn't hedge meant the balance sheet was volatile. And that was further compounded. According to some, it was further compounded by the need to actually, first of all, take pensions onto the balance sheets of the sponsoring firm, one. And two, I think Tweedy was the cause of this, to actually report the pension obligation, to report the pension scheme balance sheet using the discounting of something like gilt rate plus 20 basis points. So that was the problem. And that started long ago, long before LDI. And reading the media commentary over the last few weeks, a lot of the old sort of suggested solutions came up. A surprising number of commenters, and this is not really media sort of pundits. This is the people, if you read the FT comments and Telegraph comments, things like that. A lot of people just said, "Well, Tweedy's a bastard. Why are we bothering to report this? Just ignore it completely." You know, if you the idea is if you don't report something, then it sort of doesn't exist. So that was one sort of oddly suggested solution. Another solution, which people were saying, well, why don't we sort of move to a Solvency II or IFRS 17 sort of way of doing it? That way you don't ignore the deficit, but your pension bonds, I'll call it, on the liability side, you will basically reduce the price of that. You'll value that at a different level, so it's the same value as the sort of the bond you're using to hedge it, even if they're not really the same value. And both of these solutions basically use accounting in scare quotes to remove the deficit. It isn't really. There's also something called the contractual accrual rate, which Con Keating is here. I mean, he's had a lot to do with that. I think it's never been clearly explained to me, and it's probably a variant of the above. I might be wrong, but I don't really understand it. I'm putting it there because it's one of the suggested solutions. The other solution proposed in the early 2000s was liability-driven investment. So let's take a closer look. Right, 3 quotes which are quite important. These are quotes to the media. They don't necessarily reflect what advisors have been saying to the pension schemes. We don't know what they've been saying because we won't be told, but this is what David Konoti-Achelu, I hope I pronounced that right, was saying to the Financial Times and the Telegraph. First point, which is key, is that the point of LDI is to minimize the risk for pension schemes. The second point is that it worked, and I think, as you'll see from the presentation, it did kind of work for certain reasons. And the third point is that, as he claims, you can both minimize the risk, first point, and this point, fund managers can supercharge the returns and close funding holes, and that's a key point. You can both minimize risk and close the funding hole, close the deficit, and I immediately sort of reacted to that and thought, well, can you really do that? Finance 101, you know, the sort of stuff you're taught in business school. Can you really minimize risk and guarantee a future for millions of members of these schemes? And can you close funding holes that easily? Logics, well, at least Finance 101 suggests if you can be sure of closing the deficit in some way without risk, then you've got to have some kind of arbitrage. Can you really have something for nothing? Now, if anyone objects that there is a different kind of LDI that doesn't work in the simple model I'm going to present, I'm just going to say, well, all LDI must be working in the same way. It's basically transforming the maturity structure of assets and obligations. And you can't have something for nothing. So I'm going to present a very simple model of LDI as I understand it from those I've spoken to. The premise is that you can afford the bond to hedge the pensions by borrowing the money to buy it. So apparently you can minimize the risk to the scheme, and well, who'd have thought that? And here are the simple mechanics I'm proposing. I'm sure, I mean, many schemes will use interest rate swaps or other mechanisms. My claim is all these are going to have to be working the same way if that claim of minimizing the risk is to be true. So let's assume our pension bond, our pension obligation that we're modeling as a bond is valued at 100 million. But we only have assets whose present value or mark to market value is 80 million. So we've got a deficit of 100 minus 80, that's 20 million. So the idea is you will sell 20 million of your assets, bringing your remaining assets down to 60 million, i.e. 80 minus 20. And then you'll invest in an LDI fund, which will then borrow 80 million. Sorry, there should be an M there. Takes the 20 million that you've contributed and buys a 100 million bond as a hedge. Okay, so you've got a pension obligation modeled as a bond worth 100 million, and by a combination of equity and borrowing, you have bought a 100 million bond as a hedge, giving us 4-to-1 leverage. I'm using, there are many ways of expressing leverage. I'm expressing as debt divided by equity. So 80 divided by 20 is 4-to-1. Risk problem solved. And a little diagram just to explain that. We started with 80 million of assets and 100 million of liabilities modeled as a pension bond. After that, you've used up 20, so you're left with 60 of assets. You've borrowed 80. So you've got 100 million bonds, which you bought with borrowed money on the asset side, and an identical 100 million bond on the liability side. So you are now perfectly hedged. And I will now assume we can ignore the LDI fund completely on the assumption that it completely hedges the 100 billion pension bond. and let's set aside, which we obviously can't, let's set aside worries about margin. Let us assume that that 100 on the bottom left completely matches the 100 on the bottom right, and there are no margin calls, because the margin problem was pretty well understood and explained in the press and by Sir John Cunliffe. We understand that. We understand what went wrong. I'm interested in the 60 million of assets and the 80 million of debt. Now, the debt has to be financed at a floating rate, and I've assumed 6 months LIBOR. You can do this anyway. You could borrow interbank. You could use the repo market, which involves buying a bond and then sort of selling it again and then getting it back after 6 months. Or you could borrow in other ways, via an interest rate swap, for example. But these all amount to the same thing. If you are transforming a long-dated debt into a short-dated one, then you are exposed to rates changing. So we've got floating rate risk. And the key here is, and most people didn't spot this, they didn't see a floating rate as presenting any kind of risk at all. But there is a risk there, because if we try to hedge this risk, so we got 80 million pounds worth of debt, which is like being short an 80 million pound floating rate bond. We've only got 60 million of assets. If you want to try and perfectly hedge the risk, you'd buy a risk-free floating rate bonds with the remaining 60 million, meaning you've got basically an asset that's always worth 60 million because it's floating. You've got a debt that's always worth 80 million. You've crystallized a deficit, and that's the problem. And that's the problem I think people have missed. So let's try and model that. Let's assume we've invested 60 million in some kind of variable return, risky asset like the FTSE. And we'll assume no margin calls on the leveraged bond position, because that just makes it worse. And the data we need is FTSE values, FTSE divs, and LIBOR rates, which I've got here. I managed at some cost to get the data on 6-month LIBOR and FTSE divs. I haven't included FTSE values for the reason that they're not actually that important. And in any case, if we're modeling from 2000 to 2022, actually the FTSE has been pretty much the same level. It's gone up and down a lot, but FTSE level is not much higher today as I speak than it was 22 years ago. And the first thing you notice, it actually surprised me. I sort of had a vague mental idea of what short-term interest rates were like over the last 20 or more years. But what is really surprising, I'll see if I can get the cursor here, is that drop, which begins in, I think, September 08 and persists the whole year. It just looks like a cliff edge, doesn't it? And I hadn't really sort of thought exactly how big that was, because you get, you sort of remember interest rates being high in the early years of the 20th, 21st century. And you've had this sort of mental picture of rates being very, very low, as they have been for a long time, on average below 1%. But it's such a surprise to see the dramatic fall you have there. And then, of course, at the end, towards where we're speaking now, so it's sort of right up again. It's about 4%, where it will stay, because we had the announcement from the Bank of England today. And we got the forwards, the forward rates expressing something else, further increases in rates. 6-month LIBOR currently around 4%. The red line is just FTSE divs expressed in percent terms. It's a bit messy, it's a bit wobbly, and the reason is dividends are paid quarterly, and it's very hard to smooth them out. So I haven't smoothed them out. I've represented them as they are, and essentially, as nominal divs really haven't changed that much. So when the rate goes up, it's because the FTSE's gone down. When it goes down, it's because the FTSE's gone up. So these are the two key bits of data we need to model our floating rate exposure. I'm going to assume we took out LDI on the model I've just given above, the 60 million invested in the FTSE, collecting around 3% in dividends, and borrowings of 80 million, which are funded at 6 months LIBOR. And what happens, it's pretty bad news. If you start at that date, if you start at the beginning of 2000, you lose a lot of money. And let's just talk this through. if you look at the blue line, you see it sort of sinks. That's the amount of, that's the cumulative value of your debt that you've had to pay. You see that sort of goes negative very, very rapidly, right up until 2008. And that reflects the fact that, as you can see, there was LIBOR was over 6% at the beginning of this century. And then with the with QE and on interest rates going low, the bank rate going low, you see it from 2008 onwards, it considerably sort of slows down. And then you see a tiny little hockey stick at the end reflecting the much more recent rise in rates. So that's a cost. And remember, you are paying interest always on the 80 million. The FTSE, by contrast, now what happens there is there's a very, very steep decline at the beginning, and that is not that much caused by the FTSE level. It's caused by the fact that you are receiving dividends on 60 million at 3%, but you're paying debt on 80 million at, beginning with over 6%. And that the problem there is that it erodes the value of your 60 million assets, because you've got to pay somehow, otherwise you'll be foreclosed. That drags you right down. So the green line is the sum of the blue line and the red line. So the red line is the compound earnings on the FTSE divs, and total return. So that includes changes in the capital value of the FTSE. So red line is total return. Blue line is what you're having to your sort of total return on the short-term interest. Then you see the green line, which is the sum of the two, which is reflects the losses on your assets. Is quite incredible. You lose 40 million in the first 3 or 4 years. Goes flat for a bit as the FTSE recovers. And once we get to 2009, it never recovers. Even with the rates, with the LIBOR rates at well below what you're earning on the equities, it never recovers because you only got 60 minus 50 of assets. You've only got 10 million of assets. Even when you earn more on the assets, it no way balances what you're having to pay on the debt. So even after 2009, with the very low interest rates, you are stuck in a position where you've lost 50. So you've got 10 million of assets. And at some point, you'll have to repay the 80 million debt. So it's disastrous if you start at that time. And this slide just takes you through that. You've got 3% div on the FTSE. That's 1.8 million a year. You're paying 6%, over 6% on the 80 million loan. That's 4.8 million a year. So you're having to pay out, you're having to sell your assets, your floating rate assets, to pay the sort of interest, the surplus interest. That erodes the 60 million and makes the problem worse. The capital gains on the FTSE might have helped, but there were hardly any over this period. We were at 666, ominously, at beginning of 2000. We're 6991 October. I think it's just crept over 7,000. I wrote this presentation last week, but very little capital gain on the FTSE. The whole model depends on the differential between the earnings on the FTSE and what you pay in debt. So did LDI actually work like a charm? All the statistics Kevin and I could find suggested it grew strongly after the great financial crisis. So if you start not in 2000, but in 2008, 2009, let's take a look at the LIBOR chart. That interest averages 0.7%, very low from 2009, right up till February this year. FTSE yields 3% over the same period, plus the FTSE went up. And it did work like a charm over most of the post-GFC period, but only because short-term rates were so low. Start at pretty much any other time, and it could have turned out, and probably would have turned out, very badly. And if you understand how badly, let's start with our 60 and see what happens to our assets, assuming a 3% div on the FTSE constant, also a constant value of the FTSE, with different scenarios: LIBOR 1%, 2%, 3%, and 4%. At LIBOR 4%, it's a complete disaster. From 60 assets, you go down to 20 over the same notional period. even with LIBOR at 3%, even with LIBOR equivalent to your FTSE earnings, you're still losing. That's the that is the green line. And the reason is simply that you've only got 60 million of assets but 80 million pounds worth of debt. That's the killer. If we go up to LIBOR, even with LIBOR at 2% and FTSE earnings at 3%, you're making money, but you're not making the 80 that you need to make to repay the debt over 22 years. And only really with LIBOR 1% or below do you have any chance of getting this thing to make any kind of return at all. So overall, on pretty much any kind of reasonable assumption, LDI seems to be a disastrous strategy. I have modeled a 4-to-1 equity, as I explained earlier. Now, you can change your leverage, but there are two negative effects here. If your leverage is higher, you improve the asset situation because you've not had to put aside so much of your existing assets as equity into the to support your debt, as a margin for your debt. But then you've got an increased risk of equity exhaustion, which is precisely what happened in September this year. So you can improve the situation by improving the leverage, but then other factors will come into play, like the risk of selling at unfavorable levels when bond values fall. If the leverage is lower, i.e. if you contribute more of your beginning amount of assets to purchase the bond and have more margin, then your assets are depleted and it's more difficult to repay the debt. So leverage really doesn't make much, well, leverage just makes it worse either way, doesn't it? Now, coming to the key, LDI hedges away your fixed rate risk, right? And that's what seems to be what the consultants sold it for. So that's the solution they were selling. You remove your fixed rate risk, which it does, which it certainly does, but you've replaced it with a floating rate risk. So you've turned a pension scheme into a bank. So the one great advantage of insurance, which is similar to banking, your banks you borrow short and lend long. Insurance, you borrow long and lend long. And the advantage of insurance always is that you've got 20 to 30 years before, if anything's going to go badly wrong, it won't happen for a long time, and you've got time to sort of fix it. And also, as I mischievously point out, if it happens in 30 years' time and you're age 40, well, you're retired on a pension, and as long as it's not a DB pension, you're fine. But with floating rate risk, things can go wrong very, very quickly. You've turned yourself into a bank, and the disasters we all know with banks is that when things go wrong, you run out of funding, your short-term funding, and it goes tits up very shortly. And why did no one spot this? Yeah, the problem in my view, should have been obvious. So let's start with that Finance 101. There is no alchemy that will both minimize risk and close a funding hole. You take one or the other. If you want no risk, you're left with a deficit, a permanent deficit. If you do want to take a risk and close the deficit by having your assets sort of beat the liabilities, then you've got risk. If you hedge your risk, you've got a deficit. If you don't hedge it, then you've got risk. LDI simply transformed one sort of risk into another and more dangerous one. Should have been spotted, but wasn't. So it worked until the end of 2021 while the short-term rates were low. Now, what about 2022? What actually happened there? So I will talk about margin calls now. And the problem there is we just don't have enough data. We really don't know. We've obviously got the experience of individual schemes, but no one seems to be talking much. I had a correspondence with the pension regulator and the PPF, the Pension Protection Fund. None of what they say, perhaps I'm being very stupid, but none of what they say makes any sense at all. The TPR has said that rising long-term rates cause liabilities to fall, which is true if you're not hedged. If there's no LDI and you're completely exposed to long-term rates, then if rates go up, meaning your assets fall in value, then your liabilities will fall in tandem with that, and your position of your scheme may be improved. but we've just assumed that schemes are running some form of LDI, perhaps wholly or partly LDI, then they've hedged the change in long-term rates. I had this out with the PPF, and it turns out, I think, and they sort of omitted this, they're not including the effect of LDI in these sort of scenarios where they're saying that liabilities sort of have fallen more than assets. And also, rather alarmingly, they said they didn't have any information on losses because they only do their sort of audits and their data summary at the end of this year. So we're not really going to know what happens. And I'm not sure whether they include LDI losses at all anyway. If you look at the small print of the data they publish, they clearly state that they don't, it's an estimate only. And they don't include LDI losses, but hopefully we'll have more daylight on that. So what are the prospects? We think LDI worked sort of like a charm up until end of 2021. We don't know much about losses up to date, so that's past and present. What about the future? LIBOR is about 4%. Could go high, we don't know. Kevin can possibly talk about this. We got FTSE yields about 4%. That's not sustainable because even though the rates are equal, the FTSE yield will always be on assets that are less than the amount of debt that you've got, always, if you've taken out LDI at all. And remember that once assets are depleted beyond a certain point, the position is irrecoverable. As you saw from that graph, that chart I showed on the asset position, the whole thing collapses. It falls to unsustainable values, and within about 3 to 4 years. And that's where we are now. If schemes are still using LDI in any sort of amount, there is a huge risk there, in my view. Wow, and that's it.